Welcome back to the Sense of Security podcast. I'm Cassidy Clement, Senior Manager of SEO and Content at Interactive Brokers, and today I'm your host for the podcast. Our guest is Nicholas Colas, co-founder of DataTrek Research. The U.S. national debt is a very popular topic, but what makes up that number? And more importantly, how did we get to such a big number? These are the types of questions and details we're going to go over in today's episode. Welcome to the program, Nick.
Thank you very much.
Yeah, of course. So since this is your first episode, why don't you tell the listeners a little bit about how you got your start in the industry?
Sure. I'm a 40-year veteran of Wall Street. I started work in the 1980s at a firm called Alliance Capital, which was then just starting a big mutual fund business. So I grew with that business, went to Chicago for business school. And since the early 1990s, I've been an auto analyst at Credit Suisse First Boston. I worked for Steve Cohen for 3 years at the old SAC Capital. I've run research desks across the street. And for the last 8 years, I and a partner have run DataTrek Research, which is a daily market newsletter.
Awesome. So it seems like you're the perfect guest for this. So just to jump right in, we always hear about the U.S. national debt. It's probably something that you learn about in like fourth grade in American public schooling system. You hear about this looming, the U.S. national debt, or maybe you take a school trip to New York City and you see that huge number changing on one of the buildings. But what exactly makes up that national debt? What are the elements or the loans or maybe the types of debt that go into that ginormous number we see today?
It is a huge number. The total is about $37 trillion. So obviously a number just almost beyond comprehension. 30 trillion of that is U.S. debt. It's the bonds that you see perhaps when you go on a website and look at what's the interest rate on 10-year treasuries. The majority of that is issued by the U.S. government for purchase by the public, by people, by institutions. Most of that debt, say about 50% of it, is debt that is issued for 10 years or less. So a little bit on the shorter side of the curve, but there is treasury debt that goes all the way out to 30 years. The other 7 trillion is debt that the government issues to itself, primarily for things like Social Security and other long-term benefit programs. And it issues it directly to those parties and basically pays itself. But the vast majority of the stuff we'll be talking about today is the debt owned by the public, that $30 trillion worth of debt.
So when we're looking at this U.S. debt from more of the economic perspective, not just like breaking it down, but actually saying, okay, we have this huge number. What are the impacts? What exactly does it even allow the government to accomplish, or maybe its citizens? Because you may look at it and say, that's huge. Shouldn't that have adverse economic impact at all times if it's that big?
Yeah, let's just talk about what the debt does. So the first thing it does is simply allow the government to fund all the programs that Congress has approved. So we get tax revenues, we get things from individuals, we get taxes from corporations, we get excise taxes. Now we're getting some tariff income as well. That's not enough to actually fill the government budget. And so the government issues debt in order to fill that gap. In addition, the government will occasionally stimulate the economy during a recession by issuing incremental debt and either paying people directly or doing other programs to try to stimulate the economy. And as we talk, you'll see that a lot of the government debt that we have now is because of prior programs like during the pandemic or after the recession in 2008. And then the debt itself it's a funny thing to say, but that $30 trillion of debt makes it a must-own security for virtually any institution in the world in some form. So not only do individuals own that debt, but governments own it, other central banks own it, foreign institutions own it. It's a very popular investment because it's considered the safest investment in the world. Even at $30 trillion, U.S. treasuries are the notionally risk-free asset in the entire economic system. They're the foundation of everything that runs everything else. It's a fascinating thought that it can be so large and still so well regarded, but that's where we are.
Yeah, you mentioned the element about it being regarded. The U.S. as a country, it's relatively new. It's new on the scene. It's only a couple hundred years. So you look at the debt maybe from a timeline perspective. And if you're someone like myself who's a millennial, you can recognize those events you just said, which was maybe 2008 or COVID, where you were old enough to pretty much understand when people were saying, oh, the national debt is going to increase because of these programs or because of this relief or this stimulus. So how long really has the debt been recognized? And are there other historical moments associated that people may think about when they're studying how the number got to where it is, or why so many other outside countries are saying, oh, this is a consistent good investment? They've had many aspects or time frames or historical events as to why this is something that gets paid back or is worth holding.
Sure. Hey, the big headline here is U.S. government's never defaulted on any debt ever. The practical history of this concept goes back to World War II. When the U.S. and the Allies won World War II, the U.S. had issued a ton of debt in order to fund that program, fund that war. And it ended up working out in the U.S.'s favor, obviously. And so that was really, I think, the anchor moment, the post-World War II moment, when the U.S. became the center of the global financial system and became what's called the reserve currency. The dollar is the reserve currency of the world, meaning that when you want to buy something important, like oil, for example, or gold, you have to pay for it in dollars anywhere in the world. No other currency, broadly speaking, is accepted. And so we have to also talk about the reserve currency status of the dollar in order to understand why treasuries are so valued, why treasuries are so important to the system, because they represent dollars to most of the world. So fast forward, World War II happens, the U.S. wins, debt to GDP had gotten to 120%. It fell, and that's the measure that we use. How much debt is there relative to economic output? It then fell all the way down to the low 30% range by the 1960s. And then it began to climb ever higher. And I can recall going to lectures in the 1980s and 1990s in business school and thereafter from very important people, real thought leaders who were very worried about the deficit when it was 40 or 50% of GDP. It's now 120% of GDP, and we're still having this discussion. And interest rates are much lower than they were in the 1980s when they were 15, 16, 17%. They're 4% now. So it's hard to argue that this rising deficit, this rising level of debt, has actually made U.S. debt more expensive. And the reason is that the U.S. is considered that safest of all havens. The dollar is a safe haven, and treasuries are a very safe asset.
Yeah, there's been so many elements of concern, especially when you learn about personal finance. Initially, you say you don't want to have your liabilities outweigh your assets or things of that nature. So when you start to look at this number, if one was to make a statement out of deductive reasoning, they may look at that and say the US economy seems to be one of the economic mega powers of the world. So how did it even continue to get that high? Was there ever a time that it was maybe fully lowered or maybe even zero? Were there any times like that?
Yes, there was one very specific time at the end of the 1990s, 1999 and 2000, when the stock market had been ripping for years and the dot-com bubble was in full bloom. When there was no incremental debt issued, the U.S. actually balanced a budget. So you didn't have to issue more debt. But that was because tax receipts were so high. There was very full employment. There was very high labor force participation. A lot of people were working the maximum level in the population that we've ever seen. And that was a very brief period, literally 2 years, 1999 and 2000, when the government didn't have to issue incremental debt. It had a pre-existing debt, but it didn't have to issue much more debt. Aside from that, there's always been a structural budget deficit that has forced the government to issue more debt, and this number of debt to GDP keeps rising.
Yeah, that's so interesting. As a millennial, I remember hearing always chirps about that. At one point, it was really low or it was almost zero. And like I mentioned earlier, I remember taking the field trips and you see that number on the side of the building in Manhattan and you just can't even fathom what that actually equates to. That kind of leads me into my next question, which is the positives and negatives associated with that high of a number, or I guess in the flip side, that low of a number, because as you mentioned previously, some other nations will look to the US debt as a safe security to invest in.
Yes, again, it's this sort of fascinating dichotomy of so much debt and so much incremental debt issuance. And yet, if you look at interest rates today, they're about 4.3, 4.4% on 10-year treasuries, which is the benchmark thing that Wall Street looks at, the 10-year treasury yield. It was exactly the same in 2006 and 2005 and 2004, right before the financial crisis. And debt to GDP then was 60%, and now it's 120%. So debt to GDP has doubled, and yet interest rates are exactly the same. And I think you raised exactly the right point. The fundamental reason treasury yields haven't gone anywhere, even though debt to GDP has doubled, is because of the strength of the U.S. economy, and particularly the strength of U.S. innovation. So if you think about the biggest companies in the S&P, the NVIDIAs, Microsofts, Apples, these are global companies. And I don't think it's too much to say that the internet in the world outside of China is literally ultimately priced in dollars. It's the power of American innovation that makes this country's economic underpinning so strong and makes treasuries the safe asset. If the US didn't have that kind of innovation, if the US didn't lead the world in technology, then it might not have the same relevance. So it's not just the things that people talk about, like the laws of our country and the long-term record of never defaulting on debt or winning a big war. All of those things add up to something, but I think we also have to include the fact that the US is an economic powerhouse and continues to move from strength to strength with things like Gen AI. So it looks very clear that Gen AI is going to be a US product for the world. There's very few outside competitors. So when you layer it all together, the Treasury is not just a function of the budget deficit or the US government. It's also a function of the dynamism of the American economy and giving the world confidence that the US can continue to grow and keep servicing this debt.
You hit on this a little bit about the innovation within the country that kind of can bleed into, of course, employment opportunity and new industry. But what exactly is the impact of a high or low national debt on retail investors, or how people would see this on Main Street, let's say, instead of Wall Street? Because I know that question comes up often when you have COVID-19 impact on numbers, 2008 impact on numbers. People say, oh, how could I have seen this? Or why am I seeing this now? And it was a problem prior.
The primary issue for retail investors, and just even if you're not an investor, just somebody who wants to buy a house or take out a loan to buy a car, treasury yields are the bedrock from which all of those other loans are priced. So if treasury yields are 1% versus 4%, then the cost of a mortgage is going to be lower. The cost of a car loan is going to be lower. We saw that in 21 and 22 when 10-year yields were around 1%. And mortgages were in the threes and car loans were in the 5% range. Now treasuries are 4% and all those loans are a lot more expensive. Mortgages are like 7.5% now. So it directly impacts literally every citizen who wants to take out a loan in any form. It's a super important concept. And the fact that treasuries now are 4% and they really were never at 4% during the 2010s makes it feel like a much more onerous problem, because it affects everything else. You want to buy a house, you're effectively paying treasury yields plus. Same with buying a car. So you're pointing in the right direction. It's important to everybody, whether you're an investor or not.
Because of the nature of what you do and research and looking at things from a historical perspective, when you're saying it seems like treasury yields plus, is there anything that you've observed in the current market, or maybe you're starting to see as trends in the market as institutions maybe start to realize this is what we're offering to our customers? How are we going to, let's say, even market this as it's harder and harder for people to secure loans?
Yes. So you're right, it's a challenge because on the one hand, the typical person will want to buy a house and they're going to go to the bank and say, okay, I'd like a mortgage. And they're going to look at the monthly payment they have to make. And in many cases say, I either got to pick a less expensive house, or maybe I can't even buy a house. It's been a particularly huge problem for your demographic cohort looking to buy their first home. If you didn't buy a house in 21 and 22 when rates were low, you might be priced out of the market now, and it might not be even a possibility to buy a house. So it really comes not so much from the institutional side trying to sell something as just the numbers, the facts hitting the road and the numbers not working for a lot of people. It's also in even credit card rates. The average credit card has gone from, say, about a 15% interest rate up to a 21% interest rates as interest rates have gone up on treasuries. So it's really, companies can try to market through it by offering points or discounts or other features, but the underlying economic reality is very tough.
Yeah, I think that definitely also bleeds into, we'll say, the real young adults. As the older cousin of many younger cousins, I see those types of thoughts or gears turning in their heads as they start to look at colleges or trade schools or decisions for after high school, of being like, okay, so if I can't have a car and I need to take out loans for school, how exactly will I pay these back? I think it's really evident now, and it's probably because the world's a lot more flat. People can get information a lot quicker about the ways that that US national debt number impacts people past their portfolio, or past the idea of, oh, it's just the financial advisor's problem. It's not my problem. People are starting to see it hit their wallets, I think, a lot more close to home, literally.
Yes, the offset, it doesn't help in terms of the raw reality that you just described. The good thing is that even though the debt to GDP or debt has doubled since 2005, say, for example, so 20 years ago, even though the debt has doubled, interest rates are exactly the same. So it's not like the debt has actually pushed rates up. I know that we read about that a lot in the paper, but the historical data is very clear. It's not the debt pushing it up. It is that the economy is much stronger than it was in the 2010s. The 2010s were a very tough time for a lot of people. Unemployment was very high. It stayed very high. Economic growth was very slow for 6 or 7 years after the Great Recession. And so thankfully, we're not yet at a point where we're paying the price for these deficits. We're really reflecting a stronger level of economic growth. Unemployment is very low. Wage growth is very good. So there's some underlying economic positives, but your underlying point is super well taken, which is it doesn't in some ways matter. I mean, rates are just much higher than they were in the 2010s. So your demographic cohort, the ones behind you, are really paying the price, if you will, for having higher treasury yields. But it's not a function of the deficit, or it's not a function of excess spending. It's really a function of the economy being much better than it was in the last decade.
That's a really interesting point. It's almost a juxtaposition of how much of a good thing do you want to experience, because it almost seems like you're seeing all these positives and then you end up reaping what you sow in a negative way.
Yes, it's would you rather be employed and have a 3% or 4% a year wage increase, or would you rather have 1% treasury yields? Most people, I think, would want to take the former because it means they're employed, they're getting raises, they're living their life, versus being unemployed and therefore not being able to take advantage of lower yields by buying a house or buying a car.
That's a really good point. You brought up some great notes and points today, Nick. Thanks so much for joining us.
Thank you.
Yeah, of course. So as always, listeners can learn more about an array of financial topics for free at interactivebrokers.com/campus. Follow us on your favorite podcast network and feel free to leave us a rating or review. Thanks for listening, everyone.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.